Hey traders, welcome back to another video. Today we are talking about how to trade indices like a pro. And I'm excited for this one because of course this is a topic that I personally love a lot. I trade indices all the time. Personally, it's one of my favorite things to trade, but there's some things that you need to know about before you jump wholeheartedly into trading the US indices specifically. Now, before we get too far in this video, let me just let you know about this video's sponsor, Vantage Markets. If you're somebody outside of the US and you're wondering how can I trade US indices, you can do so through what is called a CFD. And Vantage is one of the best in the business for offering CFDs to traders. And down below in the description, we'll come back to this later, but there's a great deposit bonus that is available for people outside of the US. You can find details with the link down below in the description. Now let's jump in. So before we get too far into all the different technical analysis and fundamental analysis tips that I'll be going over in this full video, I wanted to give you a high-level overview of the four main US indices that I track the most, and most traders would agree these are the main ones. The first one is the S&P 500, and if you have Vantage, you just go SP 500. You can find them on TradingView directly, and you can trade them on there, which is super convenient. Anyways, the S&P 500 is the most I guess straightforward and most basic of the indices in my opinion. What we're looking at here is the top 500 US companies, and it offers you a pretty diverse basket of companies. Now, the S&P 500 can have anything from technology companies to real estate companies to energy companies to anything else, right? It is a very diverse list of different types of companies. And remember, when trading indices, we have to understand what they really are. They are essentially a basket with many companies within that index, right? It's basically, I like to think of it as like if you were to go shopping to a grocery store and you had a list of items to put in there from different companies, that basket reflects like the S&P 500. It's a big diverse group of companies. Now, when we're talking about the S&P 500, what you have to understand about this one is that it is more diverse than the other two that we're about to talk about. So let's go to the other extreme. We can talk about the NASDAQ. So the NASDAQ is one of my favorite things to trade of all the different indices that are out there. The reason I like the NASDAQ so much is because it is comprised heavily of technology companies. Now, technology is an exciting topic when it comes to markets because these types of companies typically have more growth, but also more risk. So you get what you want out of this one because, again, when you're talking about technology names, these things have the potential to massively grow their revenues, but they also require a lot of investment to continue to grow technology and to continue to advance that. So what you're going to find in the NASDAQ is companies like some of these ones. In here, you've got companies like Microsoft, Apple, Nvidia, Amazon, Meta, Broadcom, Tesla, and Alphabet, which is the holding company for Google. So you've got in this group a heavy focus on technology. In fact, you can see the weighting being around 34% technology. So, and when we add electronic technology, you can see it's just mostly technology companies. Now, there are some pros and cons to trading such a heavy tech related asset like the NASDAQ. And the pros and cons are pretty obvious. There's high risk, high reward in this one. And during good periods of time, the NASDAQ typically sees massive outperformance. But there's a trade-off. If we take a look at 2022, when the Federal Reserve was hiking rates and people weren't sure how long that was going to go on, we can see that the drawdown got pretty steep on this one. Had you bought at the wrong time, the NASDAQ from peak to trough was a drawdown of near 38%. That's a significant drawdown, and I don't know about you, but watching your account go down by 38% doesn't sound very fun to me. Back to the S&P 500, by the way, just for reference, the S&P during that same period of time was down a peak of about 27.5%. Still a steep drawdown, but not nearly as much as the NASDAQ. This, again, we would point to the pro of the S&P 500 is very diversified and not so heavily concentrated in technology. The third index that we're going to talk about is the Dow Jones Industrial. And here is something that you need to know right off the bat. We'll start with one of the big pros of this one. The drawdown from peak to trough in this one was only 22.6%. Again, still a steep drawdown overall, but not nearly the near 38% that we saw in the NASDAQ. Now, what is the reason behind this? Well, the Dow Jones is just a much more concentrated on safe and steady companies. I'll show you some of them. So when we take a look at the concentration of this type of index, what we can see is that United Health, Microsoft, Goldman Sachs, we have a much more diverse list. And we can see that in the sector allocation. You can see finance makes up a big chunk of this, technology services, electronic technology, health technology, retail trade. What we can see here, and the point that you need to understand, is that this is not nearly as concentrated in the high risk area that is technology. Now, the last index we're going to talk about is the Russell. Now, the symbol here for Vantage is US 2000. So when you're using your Vantage account, you can just search up US 2000 and you'll be able to find this CFD. Now, here's the thing that you got to understand about the Russell. The Russell is the small cap index, and small cap is going to represent, smaller companies. And so when we're talking about smaller companies, there are some obvious right off the bat risks to rewards with this. When you're talking about smaller companies, they have more opportunity for growth, but they also have some headwinds because they're smaller. When you're a ginormous company and you have all the resources in the world to raise money or to throw money at a project, you have more resources on your side. But again, there may not be as much growth or upside in the future. Small cap companies have a unique ability to grow very, very quickly in an expansion period in the economy. And we'll talk about some fundamental components that we'll need in order to understand this. But what you need about the basic understanding of the Russell or the small cap index is you're looking for periods of high growth. This is the spot to be in because during these times you see massive jumps. One very easy reference we can talk about is, talking about the post-COVID era. Take a look at the growth that the Russell experienced, up 100% from April of 2020 to the peak here in March of 2021. That is a massive, near doubling in just a year, which is an impressive growth. But again, with that added growth potential, you also have higher risks because interest rate environments, you could see here's the Russell from peak to trough. We had a really nasty drawdown of 33.25%. And this index is not even very concentrated in technology. In fact, it has a lot of finance companies. It's just that these companies are smaller. And so when you get a smaller based index, they're more susceptible to borrowing costs, interest rates, inflation, the economy, etc. So now that we've covered the basics of the 4 main indices that we're going to talk about today, we need to talk about some technical tips. And here's the thing that I would say when you start looking at indices from a technical analysis perspective, they have a very unique characteristic. Typically, indices rise gradually and they fall quickly. They rise gradually, they fall quickly. And over the long period of time, they typically move higher. Now, this could be very long term. It could take 10 years for a market to recover back to its previous all-time high. But generally speaking, companies grow, populations of the world grow, GDPs grow. This leads to company growth. And so they typically do rise over time. But you also have to accept that if you're going to be trading indices, watch out for these periods of time where you get steep drops. And if you're short or able to take your position off before these moves, that can be very, very key to performing well overall when trading the indices. From a technical perspective, what I find to be very useful on the long or short side is simple moving averages. I know this sounds really, really simple, but if we take a look at this moving average here and we just change this really quick to a 20 period, for example, we're looking at the daily chart. I find this to be a very useful indicator. What you'll notice is that typically the market here is respecting moving averages for the most part. And typically when you see these trends develop, they can last for a very long time. Now, when that pattern breaks down, you can see like right here, you can see some really nasty and steep drops like we saw in 2022. Now, my point with showing you this is a simple trend filter can be very useful for spotting breakouts to the upside or to the downside. And again, a simple moving average is a useful tool by all means. Now, on top of this, another really simple indicator that we could use is good old-fashioned support and resistance. What we find on the indices, especially when they are trending higher, is that they typically respect very much key levels of support and resistance. So if I just go here and I show you just some levels here, what you can see is that oftentimes when we put in a resistance level, then break out, when we retest those areas, these can be great dip buying opportunities if you have a good reason to be long an index. So again, we see this happen time and time again, where you get these big breaks, big pullbacks, and even times where later on they will respect these areas very nicely. So what I find is structure is very key when looking at the technical analysis side of things for indices. The last thing I'll say when trading them is that oftentimes a breakout of the all-time high causes people to get really nervous. But if you actually look at the studies, historically a breakout of the all-time high after a period of drawdown, it's usually a very bullish signal. And so generally speaking, I like to try and time the tops, but if I'm going to be bearish on the indices, wait for that move to start and kind of follow along with the trend, whether it be up or down. Next up, I wanted to talk about some of the key economic and fundamental components that index traders should be aware of. We'll start with GDP growth. GDP growth is a relatively simple metric. It shows, well, the calculation is not simple, but the output or the understanding of what this represents is pretty simple. This is the growth of the US economy. If the US economy is growing at a rapid pace, that's generally going to be positive for stocks. And if the GDP is declining, that's going to be bearish. So what we've done here, as you can see, the yellow line is the forecasted value for the GDP number. And then the column is either blue or red based on whether or not it beat or missed on those numbers. So when we see beats and we see the economy is humming really good, that's typically a positive sign for stocks, and vice versa when it underperforms the expectations. Another key area of economic health is to keep an eye on the jobs numbers that come out monthly from the United States, specifically the non-farm payroll or the NFP event. Now, what this shows us is jobs growth over time. If the economy is seeing lots of jobs added, that's usually a good sign that people are employed, the consumer is healthy, spending will continue, and company earnings will likely be a good result, right? Strong earnings for stocks, great for the stock market. Poor earnings, not so great for stocks. And we can trace that back oftentimes in large part to whether or not people are employed or if people are losing jobs. This is a really key economic indicator for trading indices if you're going to keep a fundamental perspective in line. Another thing you'll want to keep in mind if you're going to be trading indices is watching key company earnings and how they perform. Recently, some examples would be Microsoft and Apple and Google. When they report their earnings, these are big companies that really drive the sentiment of the stock market. If things are going well, these indices will likely continue to push up, and if things are going poorly, the indices can quickly drop, whether that be the S&P, the NASDAQ, the Dow, etc. Remember that different indices trade with more or less volatility and are reactive to different fundamental things in different ways. So for example, if the interest rates that are expected from the Federal Reserve are likely to go up higher, smaller cap companies are going to struggle more so in that environment. Remember, if the Fed is raising rates or keeping rates higher, what that tells you is that borrowing costs are going to be a tricky problem for traders because, again, people are going to say, well, small cap companies, we could go back to US 2000 for a second. We can say that when interest rates are expected to be higher for longer periods of time, it can really negatively impact the Russell or the US small cap index. So again, what we can see here is this was a period of time where inflation was problematic, it was high, and so the Fed looked like they were going to keep rates for higher for longer, and that is again a problematic thing for companies that are more sensitive. Same thing with technology. Technology is also sensitive to rates and whether or not they are higher or lower. Remember, this is rates. When I'm talking about that, I'm talking about the Fed funds rate, the borrowing cost of money essentially. If that's higher or lower, it has different impact on different areas of the stock market. I hope this was helpful to you. If it was, make sure to check out our sponsor of today's video, Vantage Markets. Again, remember I mentioned at the beginning of the video, they have a deposit bonus available for people outside of the US. All of the details for that can be found down below in the description. So please consider checking out Vantage if you enjoyed this video. Again, brought to you guys and sponsored by Vantage. So big shout out and thank you to them. Thanks guys for watching. If you're looking to improve as a trader, we've got some cool free resources here that I wanted to share as we close today's video. Down below in the description, there is a link to join our Discord channel or our Telegram channel. And we also have our website, a1trading.com, where traders can get access to free course material to help you improve as a trader. Remember, we are also live Monday through Friday on this channel around 9:30 a.m. US Eastern, broadcasting most live news events and that sort of thing. So hope to see you there. And also, we do have a couple videos here showing up on the screen. If either of these seems like it might be helpful to you, then make sure to click here or here, and we'll see you there.